Over the past decade, Wall Street's introduced a slew of financial products aimed at retirees that promise to protect your downside while allowing you to share in the upside of the stock market. These products include buffered ETFs, structured notes, and fixed index annuities. We refer to them as boomer candy. They sound appealing, but it's only when you unwrap them that you really find out how they work. These products obscure a critical, and I'd say even dangerous flaw, a flaw that can cost you thousands of dollars. Stick around as we do a deep dive into this overlooked but important part of why boomer candy may be more trick than treat. I'm Mike Palmer, certified financial planner and founder of Ark Royal Wealth Management. We're a fee-only wealth management firm, and we love educating people on personal finance. Today, we're exploring a little-known facet of financial products that seem too good to be true. Collectively, they're known as boomer candy because they're so easily sold to many baby boomers. And for good reason. Many of these products come with big commissions and fees for the financial advisors who sell them. Wall Street excels at creating financial products that benefit them, all while making them appear to be good for investors. But Wall Street isn't a benevolent partner. They're the other side of the trade. Boomer candy products are designed to make money for the bank, brokerage firm, or insurance company that creates them, no matter what happens to you. Before we dive into the details, it may be insightful to get a lesson in markets from one Warren Buffett.
The beauty of stocks is they do sell at silly prices from time to time. I mean, that's how Charlie and I have gotten rich. You know, Ben Graham writes about it in Chapter 8 of The Intelligent Investor. You know, Chapters 8 and Chapters 20 are really all you need to do to get rich in this world. And Chapter 8 says that in the market you're going to have a partner named Mr. Market. And the beauty of him as your partner is that he's kind of a psychotic drunk. And he will do very weird things over time. And your job is to remember that he's there to serve you and not to advise you. And if you can keep that mental state, that all those thousands of prices that Mr. Market is offering you every day on every major business in the world practically, that he is making lots of mistakes. And he makes them for all kinds of weird reasons. And all you have to do is occasionally oblige him when he offers to either buy or sell from you at the same price on any given day, any given security.
So what does Mr. Market have to do with boomer candy products like FIAs, buffered ETFs, and structured notes? All these products have returns that are determined at a point in time, and being forced to determine the value as of a specific day, in other words, on just one day, is a huge disadvantage for you, the investor. There's far more noise and fat tails in daily stock prices than in monthly, quarterly, or annual returns, as this research from Nobel Prize winning economist Gene Fama shows. Put more simply, if your outcome is determined by just one day's value, your return becomes more a function of chance than the market's. This means point-in-time valuation robs you of your most valuable investment asset, flexibility. If you own an S&P 500 ETF and the market drops 5% one day, you have a choice. You can be patient and wait for the recovery. You own a small piece of hundreds of diversified businesses. The value's still there. You just have to wait. But with boomer candy products, you are locked in to a preset valuation timetable. You own an IOU, not a collection of businesses. When that contract term ends, be it in 6 months, 1 year, or 2 years, the product resets. It's like an auctioneer banging down the gavel. Don't take my word for it. Let's ask Johnny Football how much flexibility you have to choose a better day for your valuation.
Zero.
That's exactly what point-in-time or point-to-point valuation does to your capital. It's the opposite of being a patient investor. Instead of being able to weather a temporary decline and capture the subsequent recovery, the structure of the product forces your investment to be valued on a single, potentially terrible closing bell. You don't get the benefit of being a long-term investor because the contract rules mandate a series of short-term, single-day valuations. Let's borrow another example from Warren Buffett. Think of investing the same way a great baseball player like Ted Williams approached hitting, but with the luxury of no umpire calling balls and strikes. If you can wait for a good pitch before swinging, you dramatically increase your odds of investment success. With point-to-point valuation, you not only have an umpire, it's like having to swing at the third pitch no matter where it is. The bottom line, if you invest in any financial product that automatically determines your return as of a set date, you're decreasing your flexibility, increasing your risk, and lowering your odds of success. We've helped hundreds of people successfully navigate retirement. If you're in or near retirement and have questions about how to structure your portfolio to put the odds of success in your favor, we offer complimentary consultations. Just click on Book a Call with Mike in the show notes below. Advisors who promote these boomer candy products do so by selling the idea of limited downside. But what they don't tell you is that these products introduce a hidden structural risk, point-in-time valuation risk. It handcuffs your flexibility, forces you into a potential selling trap at the worst possible time, and exposes your capital to the unnecessary volatility of a single day's pricing. Don't let the temptation of a market buffer blind you to the risk of a fixed valuation date. True retirement security comes from continuous long-term market exposure, not arbitrary annual snapshots. If you found this video helpful, please hit that like button and subscribe to our channel for more retirement tips. Thanks for watching, and we'll see you next time. If you'd like to learn more about the benefits of working with a truly independent and objective fee-only financial advisor, we welcome the opportunity to talk with you.